last lecture, you may recall that I discussed about the uh, and we noted some important aspect of Markowitz tried to cast the portfolio allocation problem in terms of risk and return. This is the return and this is the risk measured by standard deviation or variance. Marcus tried to provide a technique whereby one can arrive at an efficient portfolio of risky assets. Risky assets means the returns are not guaranteed, like equity stock. And there we notice that if any combination, for example, if we can find out portfolios which provide higher return for a given level of risk or the lower risk for a given level of return, that would be preferred. For instance, we had many portfolio combinations, some below this line, for example. So, for example, this and then a point here. Just 1 minute. So the point I was explaining that any portfolio which lies on this line will be preferred over this because this portfolio, let us say X, provides higher return and for this level of risk, whereas this portfolio, let us say Y, is offering lower return. Return is lower here and the risk is same. Let us say the 10%, and so that will be preferred. So Markowitz, provided the techniques for, and he pointed out that stocks which are the assets which are not perfectly correlated offers chance of risk reduction. So Markowitz focus was on the risky assets. How can we form an efficient portfolio? And he introduced the quadratic programming for the optimization of the risk and return trade-off. Now, this was a very important development because before Markowitz, there was no scientific method for arriving at efficient portfolios. And although the idea, as I told you in my last lecture, that the proverb that do not put all your baskets in, that do not have a concentrated investment, so was well known to the people, but people did not have idea how to form. So this is the main idea. For instance, if I draw this in a very not a curve like Simplicius, the portfolio which is here, return and risk, the portfolio which lies here is the most desirable because it is offering the highest return. And the portfolio which is here is least desirable because its risk is maximum. So this is the least desirable and this is the most desirable portfolio. And when Markowitz, base this computation of the efficient portfolio, the assumption was that the investors are risk averse. Risk averse means I am deliberately repeating these things because you should keep in mind before I discuss the other aspect, that risk averse is that a person would prefer a portfolio which offers higher return for a low. It will not be the case that if it is one risk lover, he would like to have more risk for a given level of risk. So that is not a normal phenomenon. So we assume that the investors are rational to that level, and rationality here means that they are risk averse. They dislike higher level of risk for a given level of return. Now, Markowitz's contribution is immense in the sense that he published his paper and book in 1952, Harry Markowitz, and he propounded the idea of portfolio diversification. And, and this is a very important contribution. But as far as the computational requirement of the Markowitz portfolio diversification was concerned, it demanded very high computational ability. That is, even the computer took hours for arriving at efficient portfolios. So that was something, at the time when the computing system was not developed, put a lot of burden, and onus on the computational efficiency of the machine being used. But Markowitz's idea that we should try to find out the the risk of a portfolio, and when we combine the portfolio securities in a portfolio, then as the number of securities increases, what matters is the covariance. And this idea of that covariance becomes more and more. For example, if there are 10 securities, then there will be 100, variance covariance terms will be there. 10 will be the variance, that is the risk of an individual security, and 90 will be covariance. So this idea that of Markowitz's computation was picked up by William Sharpe, who developed his model of capital asset pricing model. But I will come to the William Sharpe's model because this is what I'm going to discuss today. Now, again, I repeat. What Markowitz provides a method for computation of efficient portfolios based on risk and return, risk measured by the variance or standard deviation. And he propounded the idea that if we can combine securities which are not perfectly correlated, then there is a chance of risk reduction, or in other words, diversification. Another important factor which emerged out of this technique was that when we look at the variance covariant matrix, as the number of securities went on increasing, the individual risk, that is specific risk of the individual securities, did not matter, whereas the risk covariance, that is the co-movement of securities combined together, mattered most, because the number of terms, as I gave the example of 10 securities, dominated 90 terms for covariance, whereas only 10 for. So you can understand, intuitive understanding, how covariance dominates. That led to distinction between two types of risk. One type of total risk is measured by variance or standard deviation. Total risk is measured by, of any portfolio, is measured by SD or variance. And here there are two types of risk came in to be classified. One called individual risk of securities, specific risk of securities, or diversifiable risk of securities, or idiosyncratic, another name is there, or the unsystematic risk, that does not emanate from. And then another type of risk is the market risk, systematic risk, undiversifiable risk, or macro in risk that affect all. So this the Markowitz if you have a diversified portfolio and if the number of securities go on increases, we start this diagram that as we go on increasing the number of stocks in a portfolio, that this risk, which is the specific company specific risk, is this risk individual risk, this individual risk will go down. This individual risk will go down, whereas this risk, this risk, which is the market risk, this part will stay. And it, according to various studies, the number of stocks are 10, 15 to 20 or 30. There is a less chance of risk reduction. The total risk is made of this thing. So the one component is the individual risk, which can be diversified away, whereas the other type of risk cannot be diversified away. So that is why this distinction between partition of risk in two parts is provided the foundation of the models like capital asset pricing model, which are considered to be the edifice of modern finance. So I will today I will draw upon this discussion, and that is why deliberately I chose to repeat what I had discussed in my last lecture. Now I repeat what I said, that Markowitz provided a foundation for the provided techniques for portfolio, for arriving at efficient portfolios using the framework of risk and return, risk measured by standard. And this technique also pointed out that as the number of securities increases, the individual risk of the portfolio may be diversified away, may be eliminated. But another kind of risk, which is their market risk or macroeconomic risk or systematic risk, which affect all the securities, cannot be eliminated, that will stay. So this is a very important insight which we get it. And this development and the Markowitz theory led to the development of a model which is very famous model, CAPM, capital asset pricing model, based on the ideas of James Tobin and William Sharpe. So I will discuss this thing today, but before I come to the Sharpe CAPM model, I will just try to take you through further development of this risky. Markowitz theory provided efficient portfolio for risky assets. Risky asset means the return of those assets which are not guaranteed, unlike a risk-free. Like if you invest in a treasury bill, you are guaranteed, you will get a guaranteed return, like government securities. You will get a guaranteed return. So provided a framework for that. Once we combine risky plus riskless asset in a portfolio, what happens to the portfolio risk and portfolio return? This is the starting point of my discussion for today. And we will see that because of this incorporation of riskless asset with the risky asset in the Markowitz portfolio, then certain changes in the efficient frontier, which we discussed, emerges. Yes. Now, I told you just now that the risky assets and riskless assets. So far, we are aware of the portfolio risk formula and portfolio return for calculations we are aware of. Now, once we combine it, risky asset with the riskless asset. Riskless asset or risk-free asset, those are those assets where the return is is certain. Let us say 2%, 5%, and mostly it is represented by treasury bill. Treasury bill is the representative safe investment by the government, and its variance is zero. Since you are guaranteed a return, therefore it has no standard variance or standard deviation. It's zero. And it has no correlation with the risky asset. Since it has got zero variance, therefore anything multiplied by zero will be zero. So once we combine Markowitz, the risk efficient frontier with riskless assets, there are certain startling, certain surprising results that emerge. Now it is well known that everybody knows it. But when GameStop in 1957, GameStop is again a Nobel Prize winner in economics. He received Nobel Prize not for this contribution, but for other contribution as well. He made him. So when he combined Markowitz security with the risk-free asset, and then the efficient frontier, which was a curve like this, became a straight line like this. Let us see how, when we are combining risky with the riskless assets, then what happened to the risk and return, which we call the combinations or the line which depicts it. Efficient frontier is the line which depicts risk and return relationship. That was a curve in Markowitz. Because of the risky assets, it became a straight line. So for that, we will take up the first, the calculation of portfolio return. In portfolio return, there is no change as such. But as far as the portfolio risk calculation is concerned, we find that this change, that is the curve, become a linear, efficient line, linear. So let us see. Now, if you see that the risky return on any portfolio, let us say two assets are there, risk-free and this. So if you are investing in any asset risk-free this much, and then the rest is, that is the other, for example, 50% in risk-free, then 1 minus 0.5, that is this, will be in. So whatever return, for example, 0.5 is you are investing here, 2% here, plus 0.5 here, multiplied by 10% expected return of here. So if you multiply this thing, then you will get the return, the 6% on this portfolio. So the formula for calculation of same way, where we had two securities, X and Y, are some more than two. That way, so there is no difference in the terms of the return, it remains same. That is the risky asset as well as the risk-free assets are there. But the change occurs in the portfolio risk formula. Please keep in mind, I am repeating this thing time and again. That why I am repeating is that this portfolio, this risk-free asset, has no variability, no risk, because it is a guaranteed return. Its variance is zero. Now let us see what happens in the formula. Now this is the formula. Okay. You are familiar with this formula? This that is the amount of money invested in security, the portfolio, the asset one. This is the amount invested, and this is the formula which we had developed in the last lecture. Now if we substitute risk-free for security one and risky asset for security two, okay. So for example, let us say this is risk-free. So what will happen here? that here, since its variability is zero, so therefore it will be zero. So it means that there will be, this will go. Okay, so this will, and then this will stay because it is the risky assets. Therefore, the risk of security 2 will stay. And here in this formula is that, the complete formula is that this is the covariance. So we have written down here is covariance in other way also. So this is will be there. So when this part is, zero, this, then this entire will be drop out from this formula. The 2 into risk-free weightage and this. So any term if it is zero in the variability of security, the entire this term, third term. So it means that now the risk of the portfolio is only based on this part only. All these two have gone out. So this is, and when we take this standard deviation, this line will become, I'm sorry, this will stay, this will go away. Okay. So the risk-free part will go away, and the risky asset will. So what is happening here is that this formula, let us go back once again, explain to you. Now you see here once again what I am trying to, because please keep your attention focus here, because what I was explaining, that if risk free has no risk, then what will happen, that certain terms of the portfolio formula will drop out. So it is assumed that security one, if we assume that security one is risk free, so let us say this, because this variability is zero, therefore is zero multiplied will, so this will go. Then in this formula, this is the covariance. Any term covariance of security, since security one has zero, therefore anything multiplied will also go. So what will remain, that the risk of a portfolio will vary on the basis of, or will the move in line with the risk of the risky securities. So this was a very important, a discovery in the finance. Now it is well known, everybody knows it. Earlier it was not the case. So 1 minus RF simply means here the risky part, okay? So the amount of money. So that is why this formula, which had 3 now, is the risk of that portfolio when it is combined. When the riskless asset is combined with the risky, they will move in line with the risk of the risky assets only. Other terms, because when you are combining it, then because the other asset has zero variability, say riskless, therefore it drops and left. So this was what the James Tobin discovered, and through his, that this portfolio risk also became a linear. When you take the square root of this thing, it will become a linear line. Now the expected return, I have already told you that we'll take an example, and risk of a portfolio will be that will vary in line with the risk of the risky asset. 1 minus RF is the amount invested in risky assets, and this is the risk of the risky assets. Other term will drop out. Now, this provided the foundation for the theory of the capital asset pricing model. So let us take an example to understand this. An investor can combine risky investment with the, an investor can combine risky investment with the riskless security, such as investment in treasury bill. Assume that investor has rupees 1000. He chooses to invest 35% in common stocks and 65% in risk clear. Calculate the portfolio strength. These are the returns on this is the expected return because the return is not guaranteed, and this is a risk free. This is the risk, and this has no risk, therefore it's a zero. No guaranteed return. Now, when we calculate the risk and return of this, then it will be 0.35 into the return of that and 0.65 into risk free. So it will be 11.4%. And variance of portfolio will be the amount of money invested, 35% in security, the risky assets multiplied by the risk of that portfolio. It will be 0.09. So it means that the standard deviation of portfolio composed and one risky asset, if you take the square root, will be 0.7, that is 7% of it. Now this can be understood by this line. Please keep in mind that return of risk-free asset. Let me put it. No problem. I'm just putting it. It is a relationship between risk and return. Now, please keep in mind these 2 points. One point is risk-free. Okay. Risk-free provides a return of 10%. It is given. On the vertical axis, we have written here expected return, and here we have written standard deviation of the portfolio. So if anybody invests 100%, then it will be somewhere here. He will get 10% of the return, whatever amount is there, irrespective of whether 1000 is invested or 1 lakh invested. So we will get the return on the basis of that amount of investment. So 10% return can. Another may be that entire amount is spent in the risky asset, and this risky asset provides a return of 20%. So sorry, 20% is the standard deviation, and 14% will be the return of this. It is 14% return of this. Now you see that if in order to draw a line, you need 2 points. One point is this, another point is this. Now one can combine 50-50. For example, so it will be somewhere here, that 50% in risk-free and 50% here. For example, we have taken example of 35 and 65. The more you invest in risky, the more you will be near to this. The more you invest in risk-free, the more will be nearer to this. For example, 35, so it will be some point here. So here will be the return corresponding to this thing which we calculated, and corresponding to this will be the. So this provides a relationship between risk and return. You can see this line. If you want to have high return, you should tolerate high risk. For example, if you want to have no return, you should make investment in risk-free assets. Or you can have a combination 80-20, 80 in risky and the rest in 20% here. For example, various kind of funds which are there, they combine 50-50 balance fund, 50 in debt, 50 in this, and like that. Or investor, for example, if investor is risky, would like to take more risk, he should make investment in risky assets more. And if investor is slightly risk averse, then he should make investment. So all those things. Another important thing is that investor can invest more than the amount which he has, which we call leverage. One can have investment more than. So we will see this thing. For example, here it is again we can have an example where you are using not only your own fund, but you are borrowing 20%. You borrow it and supplement it, leverage. So this has come to be known as capital market line, and this is based on the Markowitz theory. So what is explaining that there is a positive relationship between risk and return. Higher the risk, more the return. Lower the risk, lower the return, because it is a linear positive relationship. Now let us go further and try to understand, because you know that this idea which we are discussing is based on Markowitz. This was the best efficient portfolio where it is touching is the Markowitz, the most efficient portfolio, riskier. Please recall that this line is made of risky assets. We have combined it with the risk free. So therefore, this point we are touching is this line risk free and risk the. So this line has come to be known as, for example, if somebody another line may be there where we are combining these portfolio with the risky. So this will be another line trigger. For example, if we have efficient frontier like this, we are combining it. The point here is this is steeper. This is slightly less steeper. So the various combination of 35, 65, and we can have like this. So this line has come to be known as the capital market line. Let us take an example to understand this. So what I was pointing out that not only investor can invest, but he can also borrow money for investing, which we call, so that he would like to have more. He can, let us assume that he can borrow at risk-free rate and can supplement his, which we call leverage, in using borrowed fund. So how it will work out? For instance, an investor borrows rupees 200 and he has got 1000. So it will become 1200 rupees. Naturally, he has borrowed, he will have to pay a rate of interest. And we are assuming right now that this rate of interest is 10%, the same rate at which he can invest, and same rate. But normally it does not happen that the borrowing and lending rates are the same. So let us assume that he is investing this 100, 1000. Please keep in mind that this does not make, we can find out the return, we multiply it by total, that will tell us that how much return how much amount we will get on investment, maybe 1 lakh or 1 crore like that. So let us say that he is investing more, 1.20, that is the 20% he has borrowed, and 40% is the return on the risky assets. So he will get this return, minus he will pay for the borrowing. So this will go. So it will come out to be 14.8, which is higher than if he had invested only his own money, he would have got only 14%. Please keep in mind that leverage, just I will hint at, is a double-edged weapon. He is assuming that he is able to get return higher than this. 14% is higher than 10%. Therefore, it may be the case that this turn out to be lower. So naturally, his return will go down. So we do not know, but we are assuming that 14% remain for the moment. So he has supplemented his own money and borrowed money from the bank or whatever and used the leverage. So his return, but he is also taking more risk. Earlier the risk was 20%, and but now because of this he is investing more money, so his risk will become 0.24 or 24% standard deviation. So he is earlier the risk, this was the 14% return and 20% was the risk, and now his return has gone up to 48 and he has also assumed more risk. So it is called leverage portfolio. And with the assumption that the borrowing and lending rates are the same. The same thing is explained, the same thing is shown here on this graph. You see that this, if he had made investment in only his own money, then he would have the frontier where he can have various combinations along this line. But now because this has extended now here up to here, because he has borrowed 20%, so his return will become higher, his 24.8% here, somewhere here, and 14.8% will be his return if you draw a line. So because of this. So That is why the leverage portfolio, borrowed portfolio supplementing are, you know, the is also very common in investing. Just to explain. Here, we have assumed that the borrowing and lending rates are same. If the yes,
बैटरी नहीं है, एक तो फोन में क्लास हो रही है.
Afra Malik, just 1 minute. Let me mute. So, what has happened is that if it was borrowing rate was lower and higher, then it will be a kink line. I have not shown it, but it will be like this. Instead of with this, because you will pay, one will pay higher amount, and therefore it will not be that is the natural extension of this, but it will be somewhere like here. There will be kink here. Slight. So this relationship which emerges, that there is a positive relationship between risk and return, and higher the risk, more the return. And this line has come to be known as the capital market line, which provided the foundation for the development of the uh, the, uh, the 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 capital asset pricing model. Now, just have a look at this. What I have explained till now. Because of the introduction of risk-free asset, a new set of possibilities emerge. Addition have resulted in change in efficient state from an arc to a straight line. It was earlier with risky asset, it was like this. Now it has become a line like this. The return and risk. Chosen portfolio depends on investors' risk return preferences. For example, I gave the example, if somebody would like to play safe, he will be nearer to risk free. If somebody would like to have, so it will nearer to this part. So the efficient port. So the whatever combination 50-50 will lie risk return. It depends upon the risk appetite of the investor and preferences. So he will combine. So this was an important discovery in the which was published by James Tobin in his paper liquidity preference as a behavior towards risk. So he explained this thing. Same thing is explained. The more conservative the investor, the more is placed in risk-free lending and less in borrowing. The more aggressive the investor, the less that is placed in risk-free and more in borrowing. Uh, so more will invest in portfolio. T is a portfolio which is if most efficient portfolio as far as the like them. Now this is the line which emerges after undertaking, that this is a risk-free rate. This is the lending, that is the when you are using more money, risk-free plus risky. Borrowing means leverage. You are using not only your money, and this was the frontier, the Markowitz efficient frontier, and this was the most efficient M or T I have written there. So various possibilities when only risky assets were there, were like this, and this was the line which dominated all portfolio. Combined with risk-free, this becomes CML, or like this. So, this and this is the on the vertical axis the portfolio return, and on the horizontal axis portfolio risk. So this was used by the William Sharpe to develop his model, which is the capital asset pricing. I just in 1-2 sentences I will repeat what I have discussed. I discussed that the combination of risky with the riskless asset results in new efficient frontier, which is the risk return possibilities for investor. And this offers this offers the idea about how risk and return will be traded off in capital market. The idea is that higher the risk, more the return. And using this capital market line theory, William Sharpe in the year 1950-64 developed CAPM, Capital Asset Pricing Model, also known as some people call CAPM, but William Sharpe preferred to call it CAPM, Capital Asset Pricing Model. And foundation is provided by Markowitz, and there are other people also who are credited with the development, but William Sharpe is the most famous person who is credited, and he received Nobel Prize in economics way back in 1990, along with the Merton Miller and mm, the Merton Miller, and there are two people here. I'm Hero Markowitz also. Yes, Aditya Sharma.
Sir, can you please explain the part where you told us the effect of borrowing the money and the leverage part once again?
Leverage part is, I will explain to you that leverage means that you are using borrowed money to supplement your money. Okay. So I had given that 20% is borrowed. For example, somebody has got. So when you borrow money, then you have to pay rate of interest on that, isn't it? For borrowed. And you may, let us say you make investment in stock market. So the idea behind is that one can use a leverage portfolio as well. Not only that you are using your money, but borrowed money. So that increases the possibilities for higher return, but also that results in the higher risk. So like in the earlier example which I have showed to you, this part that you see here, that when one was investing, 120, there 20% more, for example, if somebody is using 50% plus 100, the amount which he has got plus, or sometimes the leverage is very high. So it depends upon, that how, for example, a very aggressive investor, he expects that the return in stock market will be higher, therefore, and he can borrow money at a lower rate and can invest in higher rate. For example, if turn out to be lower, 8%, so it means that then that is why this creates a problem. So this is double-edged. So that is why leverage is not for individual investor, it may not be, but the institutional investors and other, they use leverage portfolios also. Not only that, they can. So this offers possibility that if you expect that the risky investment will provide you higher return, so investor can have a more aggressive strategies, and they can. It is a very common practice for the aggressive, especially the large institutional investors, to use their money. So it increases the possibilities. For example, if you are using your money, the one can have only 14, but because of this possibility has extended further. But at the same time, it is also entailing higher risk. And the assumption is that so long, and it has happened in India and elsewhere also, people use money from the stock market, and finally what happened that. So I'm not going to that mean whether it will affect it, but what I'm trying to explain is that that amount can be, so the borrowed money, if you supplement it, add it, or use it with your own fund, so that can provide further, the efficient frontier can be extended, but that will be risky. When we risky means that you are getting higher return, but at the same time risk. So this line simply says that if you want to have more return, you should tolerate high risk. It's risky. This is the import of this what I will explain. Is it clear to you or not clear?
Yes, sir. All clear. Thank you, sir.
So it leads to the development of capital asset pricing model, and capital pricing model CAPM, and most widely used concept in finance after NPV, net present value, in discounted cash value, cash flows and outflows, you like that. And when you are discounting, capital working decision, the cost of the capital are discounting factor. How do we write? CAPM answers all these questions. Just 1 minute, please. Has got, is for pricing of risky assets, all risky assets, and it has got various applications. Like when you are trying to select a portfolio, or you are trying to evaluate the performance, how good or bad a portfolio is, like you are trying to gauge the performance of mutual fund or fund managers, or if you're trying to find out the cost of capital for discounting, whether you should do 15% or 10% or 20%, from where you get this number. CAPM has got immense application in these settings. Not only it provides an idea about the how can you select the portfolio, but it also provides the idea how can we evaluate the performance of or whether they have they have performed better than the market, or what is the performance based on risk and return basis, not only. So these, like the concept like Sharpe index, Sharpe measure, trainer method, Jensen's alpha, all they are based on CAPM. So that is why you should carefully understand this, because of immense application in the area of finance. Now, this theory, capital asset pricing model, and equilibrium theory, which simply relates risk and return trade-off, simply says that there is a trade-off. If you want to tolerate high return, you cannot get with the lower risk. You should tolerate high. So like that you can, if you, and this is linear. Higher the risk, more the return, and lower the risk, more. So, and this is important from the viewpoint of not investing, but as I told you just now, for the evaluation of performance as well. So like if we recall that the various steps of portfolio, the investment process, it was that, when you set an objective and allocate the portfolios, and then finally it was that the monitoring the performance and all that. At every step, this model can be helpful. So there are two versions of CAPM. One is known as capital market line. Yes. CAPM has got two versions. Capital market line. Another is known as the security market line. But both relate risk and return. It is capital market line. So two versions are there. Now this model is for efficient portfolio. Efficient portfolio means the portfolio is already diversified, and only risk that matters is now the market risk. Okay. What about the other individual security which are not diversified? We need a general type of model. That is why CAPM has provided two models, and this is the more general one, SML, which is most widely used. For example, if you are evaluating the performance of mutual funds, there are already 30 and other stocks are there. So one can use either this or that, hardly makes any difference. But if you are trying to find out the risk of an individual security, let us say ITC, just an example, which model we should use this model. So both provide the benchmark for assessing the performance. Only thing is that here in capital market line, BSD is used because total risk of B already is reduced because of the diversification. But here is the case wherein we need the general model, where which is not diversified. So whether efficient or inefficient, and the idea, as I will explain to you later on, that when the market will not reward you for bearing a risk which is diversified. Only market will reward bearing a risk which cannot diversify. Because that when you can buy a mutual fund, or why market will reward you for assuming the diversifiable risk. So let us go through this thing and then will become clear to you. So we have, before that, there are certain assumptions behind any model. Model has got limitations. Any model is an abstraction of reality. Okay, is an abstraction of reality. In real life, it may not be. There are certain, if those assumptions are not valid, the model may also not be valid. But otherwise, if you do not have any assumption, then market, you cannot develop any model. The market is characterized by perfect competition. You may recall the assumption of perfect competition. There are a large number of buyers and sellers, and product is homogenized and entry and exit, and like same thing you can translate in terms of security market. Which state that there are a large number of buyers and sellers of securities. No seller and buyer is strong enough to influence security prices, and the securities are homogeneous in the sense that they can be evaluated based on risk and return. It's not exactly that the products are like in consumer market, we look at the products which are substitute in real sense. But here, if you cast all the securities in terms of risk return, how much risk and how return, so one can be substituted. All investors choose their portfolio based on risk and mean and variance. So they use the framework of Markowitz, the average return and the variance, that is SD. All investors have homogeneous expectation. About the future, there is a convergence and covariance and other things. And they are investing for same investment horizon. Their investment horizon that 1 year or life is same. An investor can borrow and lend at the risk-free rate. This is another assumption. Now you may ask a question that some of the assumptions may not be valid. For example, perfect competition. Sometimes there are large investors. For institutional investor, when they buy and sell, for example, if they start buying, it may push up the price. They start selling, that it may bring pressure on the price of share. Then offload and buy it. So that is, but in order to develop any model, we have, because there are some regulatory authorities as well. For instance, that you are buying more than that, you have to notify also. But large institutional investors, they cause an impact. So that is why there are a large number of investors, and no seller and buyer of security can influence it. So leave aside this assumption. Some people, even Milton Friedman, a famous economist, says that forget about assumptions. Look at the prediction of the model, what the model is saying, not the assumption. But that behavioral finance looks at the assumptions as well. They say that the assumptions, even if valid or not, the prediction of the model, what the model is saying, whether it is corroborated by the empirical studies or not, that is more important. So given this background, now let us go to. Now the first, as I said, that has got two versions. The first version is capital market line, which is relevant for the efficient portfolio. So it tries to tell us the equilibrium condition of optimal portfolio consisting of risk-free and risky assets. It traces the risk-return trade-off of the efficient portfolio. Portfolio is a straight line drawn from RF. What is M? I will explain to you. Now, this is the same thing which we had done there earlier in the beginning. Now here is a risk-free rate, and you know it. That is risk-free, that is variability is 0. Expected risk. This is the M. M is a market portfolio. I will explain what I mean by market portfolio, which is very central to the CFM. Now, as you know that when you combine risk-free and risky, so we can trace out the entire risk-return possibilities along this line. Now, if you are just investing entire amount this is the risk-free rate, and this is the return provided by the market portfolio, and corresponding to this is the risk of this portfolio. Now we want to draw this line. We find out the risk, the risk of the market portfolio and return of the market portfolio, and risk-free, that is treasury bill or other. So we can draw a line. Now this is this market, this is that, if you want to get a risk free, then their variability is zero. It will provide return will be zero. For instance, if you want to get higher return, then the return which you get it, one can know over and above this. For example, you are assuming risk. You are investing in a market portfolio. So the return will be difference, RM minus RF. For example, if you want to find out slope of any line, so it is rise over run. So this is RM minus RF divided by run this, which is zero. So this will go. So the slope of the line is, that is the risk premium divided by the risk of the market portfolio. Now the question is, what is this market portfolio? Market portfolio, theoretically speaking, should consist of all the assets in the economy. Stock, real estate, and all these things. But in real life, I'll come back to this point later. It includes not only common stock, but risky asset, coin, everything. Asset, these are all assets. But you know that, and which is completely diversified. It means that risks unique to individual asset in the portfolio are diversified. The unique diversifiable risk is also referred to unsystematic risk. It means that only risk which matter is the macroeconomic risk. Okay, so it's already diversified, therefore individual risk has been, and theoretically speaking, it should consist of. But in real life, what happens that it is proxied by some broad market index like Nifty 50 or even Sensex, Nifty 100, and like it plays a central role. It's assumed that this portfolio is already diversified, because if 50 stocks are there or 30 stocks are there, so this unique risk will not be there. So it's an efficient portfolio. So we should find out the return of these index. What was the risk of this index and what was the return? So that will act as a market return. And that should act as a benchmark for risk premium, how much over and above one should get. So this is this role which is played here. So this is the price when you are assuming no risk. This intercept in regression, you can see. Just wait, you will get this. And this is the price of the risk that you will get return over and above this, if you are assuming the risk. So, and at this, it will tell this much. The first is vertical, risk-free. Second is reward per unit of risk. Security market is a place where time and risk can be traded. And this is small. This is the capital market line, which, as I said, that is one of the most important concepts in the finance. So, for example, if slope of the line is RM minus RF divided, for example, if market return goes up, for example, let us say the market return is 15% and risk-free rate is this. So this will be the price per unit, then multiplied by the amount of risk of a particular portfolio. So now if the given other thing constant, now if the return of market goes up, and let us say variability variability remains same, so the slope will become steeper. Naturally, this will also increase slightly. That is why there is this line is always a positive line, because upward sloping means that there is a positive risk return trade-off. Higher there is, it is not like this, that the higher there is, less is the return. And if you are assuming more and more risk, then your return is going down. If it is downward sloping, it will not be. So higher, the steeper or flatter slope will determine that what is the price of the risk, in the market. The greater the slope, more will be the price of risk in the market. So this model is a general model for efficient portfolios. When a portfolio is already diversified, so even if you use the standard deviation, which is the total risk of the portfolio will be relevant. But in various cases, we need a journal type, where the whether you are diversified and for individual securities are like that. So security market line provide this. So it also relates risk and return relationship, but it says that the market rewards only for bearing a risk which is non-diversifiable. The same thing. Systematic. If unsystematic risks, the other risks are there, which can be diversified away, market will not be. In the world of CFPM, only relevant risk is the market, and that will be rewarded, not for bearing a risk which can be diversified. So this model is general model which applies to whether it is efficient or inefficient. So and that is why it relates the return of the security to the market, some broad index which I just hinted at, Nifty and others. So and tries to find how sensitive is the stock return is to the market return. Higher the sensitivity, more the market return. Lower the sensitivity, less is the market, and less is the return. So that is why security market line, and in the world of the security market line, it is known as beta, which beta is nothing but the slope of the regression line, where we take market return as independent variable and securities return as dependent variable. So I will explain to you how we arrive at this. The security of security line is simply this: risk-free rate you are aware of, risk-free rate, plus this you are also aware of. This part is nothing but the sensitivity of this. You can see that I have slightly sensitivity of stocks return covariance of security I with the market. Let us say Sensex index, some index, and this is the variance of market. That is the risk of the market. So this shows that, and actually this is the slope of the regression. That is, the return on any security is composed of risk-free rate plus the sensitivity of the stocks return with the market multiplied by this is the same thing, risk premium. That is the return on market minus risk-free. So if we can find out, for example, risk-free rate is known, return on market one can know. Only thing is one has to calculate beta of individual securities so that one can find how much return is expected on the security, based on this risk. And the risk which matters in the world of security market line is the market risk, the risk which cannot be diversified. We define this as beta, the same thing I have explained. And is simply when you define as beta, then we can write down this equation simply as this: risk-free rate without any plus the sensitivity of security with the covariance of security of I with M, that is market, divided by this, which is nothing but the slope, and this is the risk premium. I'll show to you how we calculate it. For instance, if we assume that the covariance of market, with the market, for example, I told you that RM minus I, and please recall that, that when I told you that the covariance of security 1 with 1 is the variance. For example, if you are to find out the sensitivity of Nifty with itself, so naturally it will be covariance of RM, that is the return on market, that is Nifty, with itself, which is nothing but the variance. And since slope is known as divided by this, so this will become 1. So that by default, the sensitivity of Nifty with itself is 1. Now, based on this thing, certain classifications are made. For example, any security which has got beta greater than 1, has got more risk than the market. If any security has got less risk than the 1, then it is less sensitive, so its beta will be less than 1. If it is equal to 1, it will move same as the market. So let us see how it is calculated. Beta are higher risk securities and beta are. So let us take an example to understand, and I think that will become much more aggressive stock, more systematic risk than the market, and this is explained here. Anyway, I will take up this part calculation. Let us see. Assuming that beta is slope, I think that you have done regression analysis as well. For instance, if you have got this thing, risk-free rate, beta, you are given, and this. Let us take an example, and then I will explain to you how beta is calculated. Assume that beta is this, these securities are like this. You are given risk-free rate. Return on market, let us say Nifty is given 12%. And risk premium is 12 minus 6, 6%. You are asked to find out the return of these securities. So you will just put these values. You see that higher the beta, more should be the return. For example, security D, let us. Security D has got high, 1.4. Naturally, its return will be higher than the other securities. So for example, this is 0.7, so it is 10.2% lower than the market. Its beta is less than 1. And it has got the other one is 1, exactly same as the market, equal to 1. And it has got beta 1.1, so it is greater than the market slightly. So what is given other thing, what is the variation is coming because of the amount of risk which is there, which is, we call it beta. So I think we can stop for today. I think that let you imbibe it. In the next lecture, I will take up the calculation of beta and other part and how we calculate it. But I would advise you that please refresh your memories, of regression, because beta is nothing but the the slope of the regression line. Okay. Like for example, we have got the return of a security, I, return on market, let us say, and this is independent variable, and this is dependent variable. We run a regression, and we arrive at in this way, like this, On the left side, always is a dependent variable. So this is the beta. This is unexplained variation. This is alpha. This is the model does not show. And this is beta slope is nothing but the covariance security I with M, that is divided by this. So this we will take up in next class, calculation of that. Because I understand that this is not. This requires you to simulate, and we will discuss this. If you have still any question, you can ask. The calculation and other examples, another thing, like how we can arrive at the undervaluation and overvaluation based on this thing, we will take up in next class. And I will repeat also the what I have discussed till now. Till now, what I have discussed is that based on Markowitz theory, asset pricing model was developed by William Sharpe, known as capital market line and security market line, which depicts the relationship between risk and return. And it has got two versions. One is measured by the standard deviation for efficient portfolio. Another is general version, which is commonly used, which relates to market risk, and market risk is measured by the beta, which is nothing but the slope of the risk. Higher the risk, more be the return. Lower the risk, more the return. And the only risk which is important in the world of CAPM is undiversified equities, not the diversified equities. So market will not reward for bearing a risk which can be eliminated, we can reduce to a negligible level or eliminate completely by holding a sufficiently diversified portfolio like that. So we'll continue with this thing in my next class. Unfortunately, only 14 students. Abhishek Varshane, you are in MBA? Abhishek? Aditya Sharma, are you there? Afra Malik?
Yes, sir. I'm here.
Yes, sir. Assalamualaikum, sir.
You are in MBA?
Yes,
Sir,
sir.
I'm from IBF.
Okay, who is in IBF?
Sir, Aditya Sharma.
Huh?
Aditya Sharma.
Aditya, okay. And what about Aisha and Aisha Khan? Are you there, Aisha?
Yes, sir. I'm in IBF.
Okay. You are attending first class or this is your, how many classes have you attended?
So I have attended three or four. I think it's four.
No, don't speak truth. You know that I have got the complete attendance list, you know, in Zoom the
Yeah.
facility is there. Okay.
Yes.
When
Yes,
you
sir.
join it, when you leave it. Okay.
Yes, sir.
So 3 classes you have attended it. So how can you understand the investment management? And these are not very easy part, you know. I'm trying to dilute it to the possible extent. Jasmine Malhotra, are you there?
Yes, sir, I'm here.
And Muskan Agarwal?
Yes, sir.
Nahid? Shiraz Ahmed? Shiraz, are you there?
Yes, sir.
कहाँ गायब हो गए आप भी नजर नहीं आ रहे हैं हाँ?
Sir, I was busy with my internship for the last couple of classes, so I didn't attend.
ये सब तो बहुत इंपॉर्टेंट चीज आपने मिस कर दिया है बहुत ही
Yes, sir.
हाँ जैनब तो रेगुलर जैनब है जैनब
Yes, sir. Assalamualaikum.
इस्लाम तो अब जो है ना ये थोड़ा सा वो कर लीजिए ये क्योंकि बहुत इंपॉर्टेंट दिस इज द मोस्ट CAPM तो सबसे इम्पोर्टेंट थियरी है फाइनेंस की और ये पूरे मॉडल जो है अभी कल नेक्स्ट क्लास में विल डिस्कस अबाउट द कैलकुलेशन अदर थिंग तो इसको ज़रा सा अटेंटिव होइए और ये 14-15 लोग जो हैं 23 लोग तो MBA में हैं या इन एडिशन टू द इस्लामिक बैंकिंग विच इज कंपल्सरी और तो ये तो हालत है 50% भी लोग नहीं है तो ये क्या समझेंगे एक्सक्यूज न्यू नॉर्मल हो गया है अब तो इट्स न्यू नॉर्मल कोविड का तो जो है जिंदगी तो ऐसी चलेगी ठीक है नहीं करना चाहते हैं लेकिन अब ये है कि अब थोड़ा तैयार भी रहिए कुछ अब प्रेजेंटेशन एक आध दो होंगे बाद में ओके आई एम क्लोजिंग इफ यू हैव एनी क्वेश्चन यू कैन आस्क बाय द